If you have ever eaten chili crab in Singapore, there's a good chance it was at a Jumbo seafood restaurant. Jumbo Group is the company behind that brand. It trades on the Singapore Exchange under the ticker 42R. And today we can pull apart its business, its financials, and its stock price to answer one question. Is this a buy right now? I have gone through 5 years of annual reports, the latest earnings, and built a full valuation model. So let's get into it. Here is our roadmap. First, we will break down the business itself and how it actually makes money. Second, we will look at its competitive moat versus other seafood restaurants. Third, we will go through 5 years of financials and the most recent earnings. Fourth, we will cover management's growth plan, including a brand new food hall format and joint ventures in China. Fifth, we will talk about the real risks to earnings. And finally, we will land on a valuation and a clear, data-driven verdict. Let's start with the basics. Jumbo Group was founded back in 1987 and listed on Singapore's Catalyst Exchange in 2015. Today, it runs about 40 restaurants under roughly 13 brands, spread across Singapore, China, Taiwan, and now South Korea. But make no mistake, this is overwhelmingly a Singapore story. 87% of last year's 190 million Singapore dollars in revenue came from right here. And at today's price, the whole company is valued at around $168 million, which tells you this is very much a small cap stock, not a regional giant. At its core, this business is simple. Jumbo buys crab and seafood, cooks it in-house, and sells the finished meal at a big markup. That gap is the entire business model. 3 things drive the economics of every outlet. Food costs, mostly crab and seafood, eats up roughly a third of sales and is the most volatile line item. Labor and rent make up the bulk of the rest, and Singapore's wage rules and prime mall leases are expensive. And once those fixed costs are covered, every extra diner is highly profitable. Last year, $190 million of revenue turned into just $8.7 million of profit, a thin margin typical of full-service dining. Jumbo isn't just one restaurant. It's a portfolio. The flagship is Jumbo Seafood, the chili crab brand most people know. But the group also owns Cantonese and Teochew fine dining concepts, mass-market local brands like Inga Sao Bak Kate and Kok Kee Wonton Noodle, and a halal-certified seafood brand to reach Muslim diners. The newest addition is Jumboree, a food hall that opened in December 2025 with more than 10 in-house brands under one roof at lower prices. A real strategic pivot toward a cheaper, faster format. Breaking down revenue by geography tells an important story. Singapore is 87% of the business and has fully recovered from COVID. China, on the other hand, has actually shrunk from almost $32 million back in 2021 down to about $18 million last year, because Jumbo pulled back from an earlier, more aggressive direct expansion strategy there. And Taiwan is the weakest link of all. The company fully wrote off its Taiwan goodwill in 2024. So when we talk about Jumbo's growth story, it really is a Singapore plus optionality story, not a China growth story. Every investor asks the same question about a consumer brand. Does it have a moat? For Jumbo, the honest answer is a narrow one. The brand is genuinely well known, especially with tourists, and that's real value. But there are no switching costs. A diner can walk to a competing seafood restaurant with zero friction. And there are no network effects, because this is dine-in food, not a platform. The clearest attempt at building a cost moat is the new central kitchen, which is supposed to create real procurement scale. It's a legitimate idea, but as we'll see in the numbers, it hasn't shown up in margins yet. Now, let's look at the 5-year trend. Revenue grew from about $82 million in 2021 to $190 million by 2024, but almost all of that jump was simply Singapore reopening after COVID, not organic growth. And here's the important part. Revenue has been flat for the past 2 years, while profit actually fell 36% in the most recent full year, hit by rising wages, new outlet costs, and expenses tied to a new headquarters and central kitchen. So the top line looks stable, but the bottom line tells you margins are under real pressure. Before we go further, let's check the balance sheet, because that's where a lot of small cap stocks get you into trouble. The good news here, Jumbo's net debt to EBITDA sits at just 0.70 times, which is very safe. Equity stands at $53 million and cash at $37.5 million. Yes, total debt jumped sharply this past year, but that's almost entirely new lease liabilities for the new headquarters, central kitchen, and 2 new outlets, not bank borrowings, which actually went down. So this isn't a company taking on risky debt. It's a company investing in its own infrastructure. Let's look at the most recent results for the 6 months through March 2026. Revenue grew almost 8% to $105 million, and China revenue actually swung positive, up 11.5%, a sharp reversal from a year earlier. But net profit still fell 22% to $6.2 million. Why? Higher wages, costs from new outlets, and losses from the brand new China joint ventures, which are still in their early and profitable ramp-up phase. So the top line is recovering nicely, but profit is not following it yet. And that tension is really the whole story of this stock right now. A quick word on who's running the show. Ong Kaya-meng has been with the company for 33 years and became executive chairman and group CEO in early 2025. Christina Kong runs day-to-day operations as group COO. This is a family-controlled company. The Ong family's holding vehicle is a controlling shareholder, and several family members are employees. One thing we're flagging: combining the chairman and CEO role in one person is a deviation from Singapore's usual governance guidance. It's disclosed, and a lead independent director was appointed to help offset it, but it does mean thinner independent oversight than you get at a widely held company. So where's the growth actually going to come from? 4 places. The central kitchen, completed in 2025, is management's main bet for offsetting rising wage costs and lifting margins. Jumboree, that new food hall format, could scale faster than traditional full-service restaurants because it's cheaper to open. In China, instead of building restaurant alone like before, Jumbo is now doing capital-light joint ventures, a 20% stake in a new Xi'an venture, and 49% in a deal bringing a Chinese quick-service brand into Singapore. And new outlets at Resorts World Sentosa are a direct bet on returning Chinese and regional tourists. Now let's be balanced and talk about what could go wrong. Singapore's mandated wage floor rises again on July 1st, 2026, and employee costs are already up over 14% year-on-year. The new China joint ventures could stay unprofitable longer than expected. Singapore's food and beverage competition is intensifying, which could eat into like-for-like sales even while new outlets grow the headline numbers. And frankly, the central kitchen might just not deliver the margin boost management is hoping for. That's probably the single biggest swing factor for the stock's earnings over the next few years. How does Jumbo compare to other listed restaurant chains? On a trailing basis, it actually looks expensive. A price-to-earnings ratio around 24 times, versus Heidelio's 13.6 times or Yum China's 16.5 times. But here's the catch. Jumbo's recent earnings are temporarily depressed by all that cost investment we just talked about. If you use our forward earnings estimate for 2027 instead, the multiple drops to around 13 times, right in line with its peers. So the stock isn't necessarily overpriced. It just looks that way if you only glance at trailing numbers. Let's put a number on it. Our model puts fair value somewhere between 28 and 34 Singapore cents a share against a current price of about 27.75 cents. So there's roughly a 14% margin of safety. Not bad, but not a screaming bargain either. Here's the more interesting part. When we reverse engineer the math from today's price, the market is only pricing in about 1.2% growth forever. In other words, the market is giving Jumbo almost zero credit for Jumboree scaling up, the China joint ventures maturing, or the central kitchen actually working. If any one of those plays out, there's real upside from here. So, running this through our full framework, as a dividend growth stock, it's a pass with a caveat: safe balance sheet, but weak returns on capital and only a short dividend track record. As a high growth stock, it's an automatic avoid because the growth simply isn't fast enough. Put it all together, and our call is conditional, at most a half position, and only for investors comfortable with a small, family-controlled, thinly traded stock. So here's the bottom line. Jumbo Group is a well-run, fairly valued small cap with real growth optionality in Jumboree and its new China joint ventures, but it is not trading at a bargain today. We want to see a lower entry price, somewhere around 21 to 24 cents, or clear proof that central kitchen margins are actually improving before sizing up a position. If you found this breakdown useful, hit like, subscribe for more deep dives like this one, and let me know in the comments. Are you buying the jumbo dip or waiting on the sidelines? And as always, this is not financial advice. Do your own research before you invest.